Welcome to the Traders Clinic, your regular shot in the arm of trader insights, philosophy and knowledge, brought to you by two professional money managers, Ali Crooks and Charlie Burton.
In every episode, we cover your burning trading questions and go through all things from the world of trading.
We do indeed.
Yes.
Welcome back.
And you, mate. We look smart today, don't we?
I know, yeah.
Well, you always look smart.
Not summer anymore.
No, that's true.
That's it.
Well, you always look smart. I'm usually the scrag bag that turns up in a T-shirt.
I have to make up for the lack of looks, so I've got to try and look smart. Should we get on?
I wasn't going to say anything, but yes, let's get on. So today we're going to be talking about a concept that has come up a lot in questions, or it's the underlying concept that comes up. It's when people are sending in questions asking about risk or strategy, is actually the concept is the trigger happy trader. So over to you on that one. What are your thoughts on traders being over trading or being trigger happy?
Okay. Let's trigger happy can be over trading. Well, it is over trading, and it depends in what context is someone over trading. So it could be that someone's sitting there clicking away all day long. That's just outright over trading, someone who doesn't know what they're doing. So what we're talking about really here is trigger happy, someone who may actually already have a method or an approach with how they approach the market, but they can't help themselves. They see a market going. This is how I'm going to, there's lots of examples of this.
Yes.
This is where I'll go. This is a typical example. So someone's got a style or a method that they use. And then when the market's moving in one direction or another, they get excited and they become trigger happy. And then they've started off their day or their week, because not everyone's a day trader, and that's another subject, but their day or their week, and they've been relatively disciplined. And then as the day progresses, the discipline goes out the window, and they started off doing just 2 trades in the morning, and by the afternoon they've done 22. And because what happens is they've started to go down that route, moving away from their method. And then because they've had a loss on that next trade, they're like, oh, I've got to make that back. So then that just fuels this over trading and, like you said, trigger happy. And it can be the same with swing traders it's a slightly slower process, but it's the same sort of thing. Swing traders can end up doing the same thing. So that's my initial thoughts. Yeah. Let's get going on.
To just follow on from that, I always say, what's the trigger that causes the trader to be trigger happy? So is it the fact that they've had a losing morning? Or is it that they're getting close to the end of the month and they've got this arbitrary target of 5% that they want to make and they're at 4%? So, or is it just the fact that the market's been quiet, so they're hunting or looking for trades that aren't really in line with their setups? So for me, it's often that the trader is looking for an excuse to do something that isn't within their plan, more subtly. I think if we're talking about the traders that are just trading with no strategy and no system and just banging trades in, well, there's a whole load of other things that they've got to work on before they get to this point. But for me, it's the more subtle side of it, where the trader might not even realize they're doing it. Another example might be that they have a certain set of criteria that need to be met before they place their trade, and 4 out of those 5 criteria have been met, or 3 out of the 4. So it's not that the trade is an outright howler or an outright complete rule break of what they do. It's just the fact that they are being a little bit complacent or letting a few elements of their strategy go to the side, because what they really wanted to do is just get in on the move.
Yeah, I mean, there's so many examples. So a classic example of someone getting trigger happy is waiting for the bar to close, and they don't. So, they know they cannot enter a trade until that bar, that candle, whatever it is they're using, price closes on that given bar, and they're looking at it live. Oh, it's bound to close. It's doing really well. And then by the end, they've got it. They've jumped in, even though their rules are all based on closing bars and, the bar closing in a given way, let's say, above a prior level, whatever, and that's your entry rules. And they've gone in, they've jumped in earlier, and all of a sudden, by the end of the bar, price is back down, and that was an unnecessary trade. That's a classic of being trigger happy as well. But I think the main thing, like you say, is someone who's got a plan. It just comes back down to you've got to trade your plan and stay with your plan. And that's very difficult, isn't it? I don't know why, but it is very difficult.
I think because a lot of the time, and this can be relative to day or swing traders, is using your example of the candle, is in that moment, the time period. Now, logically, if a trader's sitting at 1 minute 35 and he's got another minute and a half, for sake of argument, till that 5-minute candle closes, it's logical to say, well, it's not very long. He's got to wait to confirm the candle close before he or she enters that trade or doesn't enter the trade. But in that moment, that 3.5 minutes to that trader feels like a lifetime. And you can extrapolate that out to the swing trader. The swing trader's only got to wait until the daily close to determine whether the candle is right for the trade. But when he or she is looking at it at 1:30 in the afternoon and news has triggered a load of volatility, the thought of waiting till the end of the day can feel like a long period of time. So I think a lot of it's down to the fact that when the trader is in that moment, their sort of perception of time can decrease, and suddenly they feel like they're going to miss out. They think, well, what if that candle shoots away, or like you said, it can't possibly completely change by the end of the 5 minutes or the end of the day. But we've seen it so many times that you can't afford to judge the market ahead of what you need the market to do to be able to take the trade.
So how would we advise people on this subject of, someone's sitting there saying, actually, that's me. I'm a bit trigger happy in these examples that we're giving. How would we conclude this before we move on?
I think that's a great question. I think for me, the first thing would be awareness. So you would need to journal when this is happening, so you can actually firstly see it in black and white. Because a lot of trades will have the tendency to brush those trades under the carpet or think it's happening less than it actually is. So getting clear on, over a period of 30 trades, how often is this happening? And what are the triggers? Is there a pattern to those triggers? Is it around news that they see a candle moving around and suddenly they're impacted by that and think they're going to miss out? So is there firstly awareness, and then is there a pattern? And I like the phrase that you use, which is having that moment where you go, I cannot afford to take the trade, or I cannot afford not to take the trade. That moment where you have some self-talk that gets you to stick to your rules. I mean, you could probably expand on that a little bit.
Yeah, I mean, how do you get someone to stick to their plan? There, like you've just highlighted, it's not a single answer. There are a number of things that will help you to stick to your plan. Like you said, seeing it in black and white in a trading journal really highlights, oh my God, look what I'm doing here. If I hadn't have taken that trade and that trade and that trade, actually my performance would have been so much better. And so sometimes seeing it in black and white like that can instigate change itself. Self-talk, of course, yes. Like you've just said, I can't afford to take this trade. I know it's roaring off right now, but what if it turns around? Will I kick myself if it turns around and stops me out? Oh, yeah, I would actually. That self-talk is so, so important. And I would say, use the little devil that's on your shoulder as well. There's a little devil sitting there on your shoulder, whispering in your ear, saying, go on, take it. Take the trade. Take it. And you've got to realize this, as you said, it's this self-awareness. You've got to realize that there's this inner demon is egging you on to try and take that trade and the next one and the next one. Gamify it. The market is trying to get you. Don't allow the market to get you. See it as a game. Look, the market's going to win the game. If you succumb to the market and you start doing all those things, don't allow the market to win the game. Stick to your rules, stick to your plan, and every single day that you're in front of the market or you're about to take trades or whatever, you need to have processed this before you even sit down at your computer or opened your brokerage platform, because once you're in the moment, it's too late and you've got caught up in it all. So you need to have these arresting mechanisms. Having the trading plan is great, but you need the arresting mechanisms like we've just said there as well. Write it on Post-it notes, put it on your screen, whatever, and those things will help stop you from doing those things when you're in the moment.
Brilliant. Great advice. So we're on to the big question. So this is one I've been really looking forward to answering this one. So the 2% rule, very specifically, is 2% return per day realistic?
I love this. I was asked this literally in just this last week on social media. And I think that people are innocent. You've got to bear in mind, there's a lot of people who get into the markets. They might have only been in the market involved for less than a year. And so they're newbies, they're babies in trading terms. And so they don't know. People don't know, well, what is a realistic expectation for performance? And so they go out and they see all this stuff on social media and the internet, whatever. And so they just assume, well, it would make sense. Well, surely 2% a day is quite realistic. If I risk 1% and I have a 1 to 2 risk reward, well, on one trade, look, I've made my 2% per day, Well, there's so many facets to this. One is, let's just do the maths. It's totally actually unrealistic because 2% a day, 10% a week, 40% a month, 480% per year. But it gets worse than that, or better, wherever you want to see it, because if you're compounding at the end of the week, let's say you started off on £10,000. The end of the week, you're on 11,000. So now you're risking 2% on 11,000. So the following week, if you were to do 2% every day, you're not now making £1,000. It's now compounded on 11,000. And that would, by the end of the year, would, from a compounded perspective, actually goes into thousands of percents. It is so ridiculous, these numbers, and yet people believe it because I guess people hear what they want to hear. And so they want to know that I've got £1,000 in a trading account and I need to get that to 100,000 or to whatever. Someone that tells them that they can do that by doing 2% a day or whatever the numbers are, they're going to want to listen to that because otherwise the dream is not there, is it?
Well, so many traders are coming into trading that every trader wants to make money. No trader comes in to lose money, but it's the underlying motivations behind that. Like you said, if somebody tells them that's not possible, then the dream gets taken away. But the challenge is, I think the trader needs to examine why they've come in. So if that trader's like, I need to turn £1,000 into £10,000 because I've got a credit card bill I need to pay off. Well, already what's going to happen is they're going to unconsciously filter the information that they see on YouTube or any social media platform that tells them that's not possible. And they're going to pay attention to the information that is telling them that's possible because it fits in with their want or desire. So they have this belief. So the challenge is then they're only paying attention to the information that supports or is biased to what they want. And the maths on the basic level, it's like, well, if I can make 2% a day, and there are times where you will make 2%. So that's the problem. They're looking and focusing on the one day that it can happen and not looking at the rest of the time and thinking, well, if I just did this, or even if I did half of that, even if that percentage, I work the percentages out and they're unrealistic, what if I did half of that? And then they start to just rationalize it, but they're unaware of the realities of what it's like to be that consistent. And if it was that consistent and people were that consistent, then you would be seeing insane returns from fund managers and people outside of just the retail space would be achieving insanely bigger returns than they do because this would be possible. So again, they've got to not or ignore the information that is counter to their argument.
I think one of the other things, even if someone is logically approaching this and says, well, look, I've back tested this strategy, and and it will make me, okay. Now put it to work in the real market and you watch it collapse. Because that's what a lot of the time happens. You get a nice back-tested strategy and this is so common, they put it into the market and it works for maybe a few weeks, especially on an intraday basis, and then it gradually dies off. Or they haven't dealt with the drawdowns that particular strategy can have, and then they can't deal with that. And if they're risking too much, so there are all sorts of reasons why, even if you've got a methodical approach, because in theory, you could have a strategy that could deliver, those sorts of returns. But the problem is every strategy goes through drawdown periods. So you're not going to make average 2% a day. Let's be very clear. Any individual, if you're risking, let's say 1% on an individual trade, you could go and make 4% in a day or 5%, whatever, on a couple of trades, it could be more. But over time, you have to allow for losing periods, and it just doesn't work that way. And it's so difficult to explain to people that you're not going to be making 500% a year. Well, and that's uncompounded, so thousands of percent. is what we're really talking about. Now, what is it achievable? Could you make a few 100% in a year? And I have to, because I had one comment say, because I did a video on this, and one comment said, well, just because you haven't done it, Charlie, maybe it doesn't mean say it's not achievable. And that was a fair, valid point. But I have done 400% in a year. And so, but that was on a speculative trading account. It's very different to trading on your main account to doing something speculatively, because I'm naturally taking higher risk on that. And that still wasn't averaged out at whatever percent per day. It was more swing trading. I think there was a bit of day trading at that point when I did that. But the returns were more like this, and so the volatility of returns is high. And that's highly speculative. Should you be trying to do that on your main account? Probably not. But so it's a tough one. Yes, the potential to make a few 100% in a year is there. Are you going to do it year after year? Highly, highly, highly unlikely. If you did, you'd be the number one trader in the world, basically. And so, because most people can't. It's, even if you've got a good approach, there's going to be years where the market isn't aligned with your approach. And so there's always going to be different challenges that are going to come in that mean that it's not going to happen. So let's talk about, well, what is realistic then?
That's a great question. I think it is dependent to some extent on what strategy that you trade and seeing what some of that performance is. I think I'm going to come back to that. I'm going to skirt the question initially, but start with this: is whatever you deem to be realistic, there's going to be a period of time where you're underachieving that. So I made a point to a trader I was working with. I said, yeah, I can quite happily have 3 months where I don't make any money. And it's like their jaw hit the floor when I said it. And I was like, right, there you go. So that was like at that moment where I went, where's your expectation? Where's your expectation? You're swing trading. I was like, yeah, so my expectation is even bigger than that I could have a year where I don't make money. And I see this with traders where like they submit their back testing and they'll say, look, I back tested for 3 months and it's done this. And my first thought is more negative. So they're all excited. I said, how do you feel about those results? I'm really excited. I'm like, well, I'm not, because I automatically look at that and go, those results are skewed. What if the previous 3 months, the strategy was in the doldrums? And actually, when you average it out, it's actually not even more than 5% a month. So what is realistic? That's dependent on how you're trading. My rule is look at the results that you have, be them live or back tested, especially if they're back tested, and look at them and say, am I biasing these? So am I accounting for slippage if I'm a day trader? Am I accounting for error? Am I accounting for bias in the back testing results I've got? And at an absolute minimum, whatever it's saying on the spreadsheet, I would half the profits and double the time. That would be the absolute bare minimum. I'd probably actually say a third of the profits and double the time. And that might be an area that might be a more realistic area as to where you would be.
I had a trader who'd done a lot of back testing. He said, this trader. And he said, it's done, I can't remember what the numbers were. Oh yeah, it was back tested. It had done 60% a year. It's a classic example. He's done all this work. The work was good. All this work and all these combinations. And right, okay, so this combination, this is intraday as well. Right, okay, with this stop losses and these targets is about 60% P over however, back tested it over 2 years, I think. And he started trading it and he said, I think that was based on 1% risk. So he said, if I trade it at 2% risk, then I'll be making 120% a year. And so I said, I don't think you should do that because, as good as the back testing is, you don't know what it's going to be like going forward. And then he went and lost, 30% with it, on 1% of risk. So if it had been risking 2%, it would have been 60, and just on that alone. So I think that's a good example of, what you do as a back test versus live. But I think coming back to this whole, I always say to traders, as an independent trader, the ability to make 50% in a year is 100% there.
I like that.
Yeah, I like that. Because I've done that sort of thing. You've had some amazing years as well. So, of course, any trader has the ability to make 50% in a year, 100%, 150, whatever, in a given year. But you have to average it out. And I think another thing is to really put a twist on this. If a trader consistently made, I say just 20% per year, and you had a track record, you built a track record of just 20% a year, you would be in the top 1% of all traders. And then you could attract money to trade on the back of that. So again, because people forget, when it comes to performance, it's performance relative to the risk employed. So, because people say, 20% is not a lot. Retail traders would say that. Yeah, but that person who's yielding 20% a year, probably not risking as much as you're risking as well. So their performance actually is very good. So, but as a retail trader, yes, the ability to get into that 50% area is there or more, but you have to average it out. You're going to have years that you do really well, and you're going to have years that you're going to underperform, and then you've got to take an average from that.
I think that's a great point to end the show. I think that's great. Brilliant.
His name's Ali Crooks.
His name's Charlie Burton.
Trade safely out there.